virtual investor awareness program. This program is being organized by the Committee on Capital Markets and Investors Protection ICAI and being hosted by the Ernakulam branch of SARC of ICAI. May I request Chairman of Ernakulam branch, C. Ranjit Warrior, to kindly welcome our speaker for the day, C. Rudramurthy from Bangalore, and the participants. Over to you, Chairman.
Very, very good afternoon to all of you. Very respected faculty member for this evening, C. Rudramurthy sir, joining us from Bangalore. Very eminent, I would say my esteemed managing committee colleague, secretary of the branch, Deepa Varghese, and SICASA chairman, Salim Rashid, and other dignified participants. Welcoming each one of you to this second day of this 3-day investor awareness program. We all had a great time of learning yesterday, a very, very relevant topic or something which was very quite new and novel to many of us, where Vineet Dev ji from Pune spoke to us on the entire gamut of startup investment and startup advisory pertaining to investments. Today we have yet another very experienced personality, Rudramurthy sir, who was in fact his name was suggested from the committee themselves concerning the kind of experience he holds, concerning the kind of the grip on the knowledge on the topic that he is going to take today. He is from Bangalore. Only request that he had when we were discussing on the topic is I would suggest if it is post market hours, he'd be grateful. So that is how that is the kind of involvement he has on the market, and rightly so. He is going to elaborate and talk to us on the wealth creation part, and also to touch upon on the investment advisory part that we could give to our clients as chartered accountants and as auditors. So wholeheartedly welcoming Rudramurthy sir for today's session. We are deeply grateful that you could join us, sir. Wholeheartedly welcoming sir for the session today. My esteemed managing committee colleague, Deepa Varghese, secretary of the branch, and Salim Rashid, wholeheartedly welcoming both of you. And my esteemed participants, very respected participants we have from across the country. We'll hopefully see to have to see them more joining very soon. But nonetheless, we'll get started on the topic for the given paucity of time. Pretty much it. Let's have another great day of a great time of learning together. Thank you. Back to you, Deepa Varghese. Thank you.
Thank you, Chairman. It's my pride privilege to introduce C.A. Rudramurthy BV. He's an author of Amazon #1 selling book, Mind, Markets and Money. Sir is a chartered accountant and a holder of 5 master's degree in the field of finance and control. He is the founder, director and research head of Vajana Investments Private Limited, who are the direct members of NSE. You can find him very often in CNBC TV 18, ET Now, TV9, and many more business channels for his technical views on markets. His market codes are cited in Reuters, Wall Street Post, Economic Times, etc. He has been awarded with Nadaprabhu Kempagowda Award and Udayabhanu Kalaratna Award for his contribution in the field of financial education. With these words, sir, may I welcome you to start your deliberation on equity investing for wealth creation and investment advisory to clients. Over to you, sir.
Thank you so much. And it's my privilege and honor to be part of this very esteemed gathering. Thanks for inviting me. And I will just keep this presentation short and sweet. I will also be sharing these PPTs. I don't want someone to just keep writing down what I present. Rather, let them focus on our learning part. And this will be definitely more an interactive session. So I would request even the IT team here to ensure if people have any questions, they can put that in the chat box. And what we will do is totally, what time do I have for the entire presentation? If I can just take it from the coordinators there.
Sir, 2 hours, sir.
Okay, so what I'll do is I will have this entire presentation for about 1 hour 15 minutes. So that right now the time on my clock is about 4:12. You require any time for validatory or word of thanks or anything at the end, madam?
Just 1 or 2 minutes, sir, nothing more than that.
Okay, so what I'll do is I'll just keep my presentation for about an hour to hour and a half right now, from now, and we will have at least 15 minutes to 30 minute session for only Q&A, and I would appreciate if you can just take questions and moderate at the end. Is that good enough?
Yes, sir, that's perfect, sir. We'll do that.
Okay, thank you. Thank you so much, CA Deepa, and also thanks so much for the entire team of organizers here. My special thanks to the coordinators of Ernakulam branch and also to the chairman and to all the office bearers, and also very, very special thanks to people who are part of this program, attending this from across the country. Thank you so much. So let me share my slides, right? And are you able to see my PPT?
Yes, sir, we can see that.
Okay, great. So let me just do that. Yeah. Okay, so welcome to this session on equity investing for wealth creation. And thanks for the introduction already, but just a short and sweet message about Rudra. I'm also a chartered accountant, but from day one, I have never practiced nor have worked as a chartered accountant. And I'm the author of Amazon #1 selling book, Mind, Markets and Money. I'm the only Indian who was there in the dais of top 5 world's best trader trainers declared by Online Trading Summit 2019. I come as a guest speaker in CNBC TV 18, ET Now, TV9, Public TV, and many more. And also my articles are cited in Money Control, Economic Times, Wall Street Post, and many more. So today, let us discuss how one can create wealth through equity investing. So first of all, even before I start this particular presentation, I want to tell you guys that even though I'm a chartered accountant, I'm not a practicing chartered accountant. So any questions on, let us say, professional conduct, anything to do with taxation part. So I am not an expert. I don't want to take any questions relating to it. In fact, I would love to learn those things from you because you are all practicing chartered accountants. So even though I have some fair idea about taxation as well as professional code of conduct, but these two areas I don't touch at all. I come from investment background. So anything related with capital market and investment, I would love to share my experience and expertise there. In fact, very recently, there was another international session again done by Institute of Chartered Accountants of India, where I shared a dais with Girish Ahuja sir, and he is the Bhishma Pitamaha of taxation. So he handled areas of taxation and professional conduct, and he told anything to do with investment, trading, stock market, ask Rudra. I might have only a basic knowledge on it. And similarly, anything to do with your income tax or anything to do with professional conduct, yes, he was the authority to talk on it. So I'm just making this very clear right at the beginning, even though you might be more keen to know about the taxation side as well as professional conduct side, I don't talk on that because that's not my expertise area. So I will restrict all my discussion on investment arena. Anything to do with capital market, stock market, you want to have your questions answered, I'm very much there to help you out. And let us just start with this background, equity investing for wealth creation. Now, first of all, how many of you here wants to retire wealthy and you want to enjoy your financial freedom? So I want you to go to chat and answer me if you are interested to retire wealthy and enjoy your financial freedom. So how many of you here wants to retire wealthy and enjoy your financial freedom? If yes, go to chat box and write down me in the chat box. I think chat is open and people can write there. I want this session to be interactive, and people believe it is only offline sessions which can be interactive and not online. Thanks to COVID, right now I've adjusted so much. And in fact, today I prefer all sessions only online, even though we have everything opened up right now. So guys, I want each one of you here to participate. Questions we will reserve it for the end. So if you want to retire wealthy and if you want to enjoy your financial freedom, yes, this session will show you how to do it. And I will also tell you in this session how to achieve your financial freedom and be your own boss. I know you're all guys who might practice or you might be working as chartered accountants, but we will learn how equity investing is important for wealth creation. Now, first of all, in today's session, I'll be focusing on how one has to invest or how one has to stay away from equities during challenging times. I'll also tell you about what is financial freedom and how one can achieve it at the earliest. I'll also tell you about power of equities and how compounding works. In fact, compounding is the eighth wonder of world, and I'll tell you how it can be used for And let me also give you current economic scenario and what the stock market behavior is. We'll also look at what sectors might outperform and underperform for the coming years. We'll also see if you have any specific questions. I'll try to give you customized solutions, and for which we will reserve our last 15 minutes to at least 30 minutes of our time at the end only for Q&A. So this is what I want to begin with when we start or when we talk about equity investing. This was the question asked to one of the world's best investor, Warren Buffett. He was asked this question, why people don't become rich? And this question was answered by Warren Buffett so beautifully. And Buffett told, people don't become rich because no one wants to become rich slowly. And if someone can understand this statement, it has so much meaning when it comes to creating of wealth. There is a difference between just becoming rich, which is short term, and creating long-term wealth. And Buffett beautifully says this. He says, most of the people don't become rich. They die poor or they die average. They don't create that tremendous wealth only for one reason. That is, he says, no one wants to become rich slowly. People want to become rich very fast. And that is the number one reason why people don't become rich. So the big learning what we have to get here is we have to give time for time. And let me tell you, go to India's top 10 richest people list and find out who is the youngest among the top 10 richest people in India, or even if you go to the world's top 10 richest people and see what is their age, on an average, it will be 55 to 60 years. So you have to give time because compounding effect works only when you have given that amount of time. So if people try to become rich very soon in their life, the chances of they losing money will be very, very high. And one has to understand you have to give time for compounding effect to work and for you to create massive wealth. So beautifully Buffett says, the number one reason why people don't become rich is because no one wants to become rich slowly. And with my 18 years of experience in capital market, I'm giving you this answer with my experience and expertise on why people don't become rich, other than the point given already by Warren Buffett. And this is the answer. I say, no one wants to become rich by putting the work. Everyone wants to become rich doing nothing. And when you do nothing, what you get is also nothing. You have to put in at least the smart work, if not the hard work. So if you do nothing, what you get is also nothing. So if people are ready to put in the time, if people are ready to learn the secrets of this equity investing and to create this massive wealth, and also if you are ready to put in that smart work, yes, becoming rich is a scientific way. And we will learn that in today's session. Now, I want to tell you, first of all, the power of passive income, because for equity investing, it is very, very important. Now, first of all, let us understand what is passive income. In fact, first time when I ever heard what is passive income, I was shocked. Someone told me passive income means income what you earn by doing nothing. I was shocked. How can you earn something by doing nothing? And people were telling, your money should work even when you are sleeping. I was just asking them a question. When I'm awake only, my money is not working. And when I'm sleeping, how can my money work for me? So that is when I realized I was not knowing what is passive income. And let me now make it so clear to you. You have to create massive sources of passive income to generate long-term wealth. And let me tell you what is this passive income. Income, what you earn by doing nothing, is passive income. Let me give you an example. I have a commercial property in Bangalore and I've given it for rent. Even if I do nothing, I do only Kana, Pina, Sona. So even if I do Kana, Pina, Sona, I still get every month a rental income of 8,50,000 rupee from my commercial property. So the rent what I receive from my commercial property, is it a passive income? Answer is clear, yes, sir. So passive income is that income what you earn by doing nothing. And if you want to create long-term wealth, it is very, very important for you to create many sources of passive income. Let me give you one more example for passive income, and I'm just giving you my real life example. I'm an author of Amazon #1 selling book, Mind, Market and Money. I have this book with me here, and this book, whatever I have in my hand, I have written this and I keep getting the royalty of 20% on every book which gets sold. Even night when I'm sleeping midnight, someone goes to Amazon and orders a copy of this book. He or she makes the payment and buys this book. 20% of the rate, I get it as my royalty income. So tell me, is it a passive income? Me doing nothing, still I get my, do I get my royalty income? Answer is yes. So what I receive as an author, the royalty income, is it a passive income? Yes. I'll give you one more example. Let's say you have put in money in a bank FD. I'm a guy who invests more in equity. So let's assume someone has put money more on a bank FD. And let's assume a very nominal low interest rate scenario of 5.5% per annum. So if you go and invest 1 crore in a bank FD and you receive, let us say, 5 lakh rupee interest income on it, and tell me, is that interest what you receive on a bank FD a passive income? Answer is definitely yes, because by doing nothing, kana pina sona also, you keep getting this income. So the income what we earn by doing nothing is passive income. This is easy, but let me share you my practical experience and expertise. The story of the farmer and the golden goose. I'm sure you all know it. So every day, the golden goose story, every day, the goose used to give that golden egg. The farmer thought, why to take every day one egg, one golden egg? Let me cut the goose and take more. And then what happens is, when he cuts the goose, inside what he finds is nothing. So let me tell you, similar to this story, the most important point you have to learn is to create these assets, like for example, the commercial property, like for example, the FD, what you have put into the bank. You have to work and create that income through which you buy that asset. The moment you cut the golden goose, the passive income source will stop. What do you mean by this? Very simple. If you withdraw the bank FD, you don't get that every year interest income. If I sell my commercial property, do I get my rental income? Definitely no. So never cut the golden goose so that the passive income sources keep coming. And the most important point is to create passive income, you should have worked before so that you earn that income to buy those assets, which gives you that passive income. If not you, it should be an ancestral property or you should have got it from someone. So there should be an asset. So do not ever think about creating passive income immediately without having worked for some time. But however, if you even earn 5 lakh rupee monthly salary, I say you cannot create massive wealth through working income. You have to create many sources of passive income. So when you create multiple sources of passive income, doing nothing also, you will be in a position to earn that income. And that is where creating multiple sources of passive income is very important in order to create long-term wealth. So let me just go back and then share my presentation back. So you all just learned now on what is passive income, how it is created. And let me tell you, passive income does not include working income. So if you're working in a company, you get some salary, that's a working income. So passive income and working income are two different things. And I've given some examples for passive income, rent, interest. Even when you have invested in shares for long term, you keep getting dividend, and that dividend income also becomes passive income. So many more I've just explained. Now, I'm sure you also got this story of the golden goose, and you have to create multiple sources of passive income to generate long-term wealth. Never cut the golden goose, the most important learning, and you have to work first to create these massive sources of passive income. And let me now go to the next topic. What is financial freedom? So your current passive income sources should exceed your current expenditure for the lifestyle what you are leading as of now. Then I say you are financially free. To make it very simple, let me repeat. Whatever is your current monthly expenditure, let us say my current monthly expenditure is 50,000 rupee to lead my current lifestyle. I'm not talking about expected lifestyle or the lifestyle what you dream for. No. My today's lifestyle, whatever I'm currently having, for that lifestyle, example I'm just telling, if I have a current lifestyle for which I require 50,000 rupee per month, if you are able to earn that money through passive income, I'm not talking total income, I'm not talking working income, I'm only talking about passive income. So if you're able to earn that money only through passive income, then even if you don't go for work, your passive income is greater than the current monthly expenditure, then you are financially free. So to become financially free, the equation is very simple. See whether your current passive income sources are greater than your current expenditure to lead the lifestyle what you're currently having. However, if you want to account for even inflation and taxes, I will say double that. So I have at least 2x of your current monthly expenditure as your passive income source, and that gives you financial freedom. And you can decide only when you want to work, you work. If you don't want to work, you don't have to work. You will be your own boss, but still we do it because we can't sit idle. So today, my current monthly passive income, what I earn, is far greater than even 2x of my monthly expenditure. So am I financially free? Answer is yes. Now, if you have to plan for your financial freedom, ensure you create massive sources of passive income and you plan your current monthly expenditure in such a way that your passive income exceeds even after tax and inflation the monthly expenditure what you incur, so that you are financially free. And what is financial freedom? That's what I said. You will work only if you want to work. If not, you don't have to work, because already your passive income sources will take care of your current lifestyle. Very briefly, let me give you my story quick so that you understand the background of wealth creation. Whenever I used to see this photo, I used to see where is my photo or when will my photo come there. This is the list of world's richest people. But then let me tell you, someone told you do CA, you will become rich. That's how I did CA and became a proud chartered accountant, but later realized to do massive money, you have to be in stock market. So that's how I entered stock market in the year 2003, 2004. Today, the experience of Rudra in market is about 18 plus years. And I started with a very small capital of 10,000, did great in 2008. When the Lehman Brothers crisis came, I lost everything, went into even negative territory, debt because of F&O, and I had huge long position. Market at Nifty level tumbled over 60%. I'm talking about index level. And if someone has seen that bear market and still survived in the market, I'm sure he will survive for the rest of his life. And I thought my career is over and I have nothing more. So this was my situation in 2008. But the only silver lining was I was not ready to give up. And I used to always say, if I cannot make money in market, no one in this world can make, because I was ready to put in the hard work and effort. And that's when I started investing on my learning. I started learning from the best of the best, attended a lot of training programs. And today I say I achieved my financial freedom so early. And it was at the age of 33 when I achieved my financial freedom. I'm also the founder director of an NSE direct member company called Vachana Investment Private Limited, and I am my own boss and I work only if I want to work, and this is possible only if you understand the power of equities. Now, you have the India's Warren Buffett, Rakesh Jhunjhunwala, and his guru, Radhakishan Damani, owner of Walmart, and all these people had so much of influence on my learning and on my life of last 18 years in capital market. So even you can enjoy your financial freedom provided you understand the power of equities. So I have this mission to assist investors with reasonable expectation to achieve their financial freedom at the earliest. And the big question now, should we invest now or should we stay away from equities during these challenging times? Now, I know people ask me this question often, and let me tell you, irrespective of the current market environment, I say you have to remain invested in all ups and downs of market, and you have to pick the right stocks. That is very, very important. And Warren Buffett says this beautifully. It is not enough, or he says very clearly, you don't have to focus on the forest, you have to focus on the individual tree. So you should know the company in which you are investing, the sector in which the company is running, and you should know the financials of the company. And for shorter term, if you want to understand even the market sentiment, that is where technical analysis will come into picture. And let me tell you, it is all with the stock selection, and it is not with just the overall macroeconomic factors. Many a time people ask me, right now the inflation is very high, right now Fed is doing tapering. Now, is this not a bad time to put money in market? Valuations are very expensive. Yes, these are all at overall macro level, but still if you find good businesses run by good management at good price, I will say it is great time to even buy. Why today? I will say now. And let me tell you, it is all to do with the right stock selection, which is very important in equity market. Okay, now I will also tell you this. This is one advantage you have. That is, Buffett says this beautifully. He says, be greedy when others are fearful, and you be fearful when others are greedy. And this statement has worked 100 years back. It works even today, and I'm sure it will work even 100 years from now. When everyone wants to buy something, you have to give it to them and say, take this and you be a seller. And if everyone wants to sell something, you have to be a buyer. You might call this as contrarian investing, but let me tell you, this is where greed and fear as a psychological factor plays such an important role. So I'm sure during COVID times, March 2020, people thought the world is over and everyone were sellers in market. That is a time when people who understand equity market better were there buying because everyone wanted to sell and everyone, the street was fearful. But let me tell you, even at least as of today, we are hearing even the third waves and things which are happening outside India, all that stuff. But let me tell you, COVID is not a cancer. COVID is a flu. I'm not a doctor nor an expert on health to talk about it, but let me tell you the way people behaved during those times of COVID, and people were selling markets left, right, center and their stocks left, right, center. That was the time when someone who understands this statement, be greedy when others are fearful and be fearful when others are greedy, would have put their money. And that comes with rich experience of 18 plus years for me in market. But then if you people are new to market, these type of opportunities do come at least once in a decade. That is a time when you have to load your truck with good quality companies, and that is when you get it at cheap prices. And let me tell you, even look at Nestle. And before even I start talking much about companies and real life examples, let me make a disclaimer right at the beginning that I might have direct or indirect interest on the stocks, whatever I talk here. And these are just for educational purpose and example, which I'm taking from real life examples. And do consult your financial advisor before you act upon it. And whether it is profit or loss, you enjoy or you suffer it. Now, getting back, when the story of Maggie and the lead in it and all that came, you had a huge fall in the price of Nestle, and the stock was available at 3,000 rupees. Only during these tough times, you get mouth-watering valuation comfort. That is the only time when Nestle was available to you at a throwaway price to buy, and from there it has gone up only 600% or 6 times in no time. And this can happen because of valuation comfort. So when others are greedy, you have to be fearful. But when others are fearful, you have to be greedy. But then you have to pick up right companies. Many people think we have to buy only stocks which are of less price. No, you have to look at the market capitalization, you have to look at the value available on your table, and what is very important here is stock selection. Many a times people ask, how do you select stock? It is not a simple answer, one line answer which I can give. It is like going to Sachin Tendulkar and asking, how do you bat? Or it is like going to Virat Kohli and ask how to bat like you. Not possible. They have put in 15-20 years of effort, experience, practice, training, everything into the game of cricket, and the result is what you see today. Even if you put in the time, effort, practice of what they have put in, the result should surely come to you. It's a matter of time. So this is where people have to understand. It's not a one single line question and an answer where I can say, this is how you do stock selection. But let me tell you, using the fundamental and the technical analysis is how one can pick stocks. No doubt your experience and expertise also adds a lot of value towards stock picking. And this statement reminds me again and again, when you get great opportunities, either because of company specific reasons, like I told Nestle as an example, where you have the reason why the stock corrects, but that cannot remain forever. And that is a time when the street is fearful. You have to be greedy enough to buy them or buy these great companies at throwaway valuation. And one more opportunity you had was during COVID times. So COVID is definitely a good opportunity or a godsend opportunity for people to have bought great companies at throwaway prices. And like this, we get many more opportunities often. But are we open and have we got that learning to buy them at right prices is the big question what we have to ask ourselves. Now this is Benjamin Graham. He is guru of Warren Buffett, and so beautifully Benjamin Graham says, he says the intelligent investor is a realistic person who sells to an optimist and he buys from a pessimist. Very, very important. You should never be desperate when you are a buyer or a seller. So if there is a desperate buyer who is ready to buy at any price, your job is to sell to him. And similarly, if there is a desperate seller who wants to sell at throwaway price and he wants to get rid of his stock, that's the time when you have to buy. So always an intelligent investor is a realistic person. He always sells to an optimist and he buys from a pessimist. Very similar to this greed and fear, and very similar to what Buffett told before. This is his master Benjamin Graham, guru of Warren Buffett, who says it so beautifully. He says, as an investor, you have to be a realistic person and you have to sell to an optimist and buy from a pessimist. And I always say this, buy quality over quantity. Very, very important. You have to buy quality over quantity, but at reasonable prices during crisis. Because reasonable price comes only during crisis. That is a time when you should have the right temperament to buy great companies or quality companies at reasonable price. Now, moving further, people ask me, what is the get rich quick adventure scheme in equity investing? So how do I get rich faster through equity investing? There is only one way to do it faster. That is, you have to understand the mastery tip, which is power of compounding. I always say, or this is the statement of Albert Einstein, but I always say, Albert Einstein told this, compounding is the 8th wonder of world. But I say, continuous compounding is the 9th wonder of world. If someone can understand the power of compounding, you will be just growing long-term wealth easily. And this is what equity investing is all about. And for this, let me give you a simple example and a story. And I'm sure you would have seen this tree, and this is a picture of a bamboo tree. And if you know the story of a bamboo tree, the tree which grows about 50-60 feet tall, if you see the tree for first 5 years, You can't even see a small sprout coming out of the land. Even from the surface of land, for first 5 years, there is not even a small sprout which will come out. But for that 5 years, you have to manure, you have to put water, you have to take care, do everything. And then once a small sprout comes out after that first 5 years of nurturing, then you see the tree growing 50 feet tall in just next 5 months. Now, even though it takes 5 years, 5 months for the tree to grow on an average about 50 feet tall, the first 5 years, there is no growth at all outside. But then the tree was growing inside. So similarly, we have to put in the time for our own learning, and we have to first grow inside. To see the outside growth of 50 feet tall in 5 months, you have to put in that amount of learning, patience, nurturing, and all that what you have to do for the first 5 years is to ensure the sprout, once it comes out, then the growth of the tree will be so fast and it grows so height of 50-60 feet within no time. So this is what we mean by power of compounding. Now let me tell you how one can make at least 100 crore in one's lifetime and you can retire early. There's a simple secret, and that's what I'm just revealing to you guys today. Now, if you want to understand the power of compounding, you have to understand there are 3 important points. Number 1, you have to have initial investment. Now, when I say initial investment, people ask me this question: what should be the initial investment which is required for me to create that wealth of 100 crore? And let me tell you, this method, whatever I'm giving you, is so simple and easy, and you can also make note. What you require is, I don't know if I can put this on the board and write. Okay, so do I have a writing feature here? Just a second. Yeah, so very simple. This power of compounding, whatever I'm just telling you, you require, let us say, a small capital. I'm just starting with a capital of 10 lakhs. So if you have a capital of 10 lakhs, that is enough for me when it comes to an initial investment. So let us say you have a capital of 10 lakhs with you. I will put that for initial investment. And even if you can earn a return on investment of about 26% per annum. Now people ask me this question: how can I make 26% per annum return? Let us not talk about it right now, but let us just learn the power of compounding. I'll come back to that. So if you have an initial investment of 10 lakhs, if you can earn an ROI of 26% per annum, and if you can spend a time period of 30 years, just do the mathematics. If you can invest 10 lakhs, earn a return on investment of 26% per annum, and if it is kept for 30 years, the power of compounding says your 10 lakh will turn into 100 crore within 30 years with a return on investment of 26% per annum for an initial investment of 10 lakh. Now this is what we call as power of compounding. Now listen carefully. If someone says I cannot make 26% per annum, very difficult. No problem. Even if you can make 10% per annum, if this is your ROI on your investment, I have to increase my time period from 30 years to 45 years. So even with a lower ROI, but with a higher time period, I can still achieve that final output of 100 crore. Or I have to increase my initial investment. So instead of 10 lakh, let us say I'm able to put 20 lakhs or I'm able to put 50 lakhs. How do I increase my initial investment? That is through my working income, and you have to generate that income, do whatever you are good at, earn that money, simple. Or you have passive sources of income, you have already earned, created assets, and you have passive sources of income, still that's a great point. So I'm only trying to tell you right now, the simple technique here is, You have to take care of three things when it comes to power of compounding. So what are those three things you have to take care? One, you have to ensure you have an initial investment of 10 lakh. That is initial investment. How do you earn this? That is through what you are good at, do that and earn that income. And two, as I told you, you have to even take care of your ROI. How do I do this? When you have more knowledge, experience, expertise on market, why 26% per annum? You can even look for more. But then as the size of capital keeps growing, it is not easy to make that ROI, that too consistently. But even if I make 15 to 20%, that is good enough to earn my output. And time period I have taken 30 years. And now let me give you the secret of Warren Buffett. And I'm sure many of you would have heard many a times that health is wealth. But you would have never understood how health is wealth. And let me tell you how it is. Now we learned in power of compounding, three important variables have to be taken care. Number one, initial investment. That is whatever you save. So you earn income and you have some expenditure. The balance is your saving. More the saving you have, more the money you have for investment. So you have to ensure your initial investment is high. And to earn 100 crore in one's lifetime, 10 lakh initial investment is good enough for that output. Number two variable, or the second variable, what we learned was return on investment and an ROI of 26% per annum. Even if you can make 15%, 10% also, then instead of 30 years, I have to increase it to 45 years. Now, the third important element is time. That is, more the time you give for your initial investment to earn return, the power of compounding works superbly. And let me tell you, if you can increase all the three, that is, you are able to increase your initial investment, you are able to increase even your return on investment, you are able to increase even your time period, the number output of 100 crore, whatever I am talking, is too small a figure. But let me tell you, very important point here, it is very tough to earn the first 1 crore. And if someone takes, let us say, 35 years to earn his first 1 crore, he will not take 70 years to earn the next 1 crore. Because there is something called as power of compounding. It is like the snowball which is just falling down the hill. As the snowball falls down the hill, it will gather more and more snow and also more and more pace. That is how the power of compounding works. And let me also tell you, when it comes to power of compounding, Albert Einstein told, I don't know which are the 7 wonders of world, but I know the 8th wonder of world, that is power of compounding. I'm telling you, if someone can understand power of compounding, and if you know what is continuous compounding, the power of continuous compounding is much, much bigger, and the money grows and long-term wealth is created through this. But do you have the time? Do you have the knowledge? Do you have the expertise? Do you have the wisdom? And do you have that inclination to create wealth? I know, let me also give you the story. A saint went to Bill Gates and he told, making money is nonsense. I repeat, a saint went to Bill Gates and told, making money is nonsense. He said, you don't have good relationship, you don't appreciate spirituality, so all that money what you have made is nonsense. Bill Gates just replies back, he says, you first make enough money before talking such nonsense. So let me tell you, only Bill Gates can tell making money is nonsense because he has made enough. And let me also tell you, today's world of spirituality is not scarcity. Real spirituality is abundance. And I know many people who fail in life and they take an excuse giving spirituality as the reason. And let me tell you, this is my statement with my experience I'm speaking. I know a lot of people who are humble. You know why they're humble? Because their pockets are empty or they might have failed in life. But let me tell you, if you are successful, if your pocket is full and then you are humble, that is real humbleness. And let me tell you, spirituality, happiness, health, wealth, everything can be balanced and even achieved. So it is an and life. It is not an or life. It is not healthy or wealthy. It is healthy and wealthy. And let me tell you the secret of Warren Buffett here. And we would have heard this statement a lot of times. Health is wealth. Warren Buffett started investing when he was 12-year-old. And today, even at the age of 90 plus, Buffett is still there in market. So it is just not enough to start early. You have to even end very late. Buffett having started at the age of 12, even at the age of 90, if his money is working for him, that means he's there in market for how many years? 90 minus 12, his T or time period is 78 years. In the example of creating 100 crore wealth, the time what I asked was only 30 years. So why 30 years? Generally in India, we start at around 30 and retire at around 60. So our working life is 30 years. But if you can expand that, see the amount of wealth you can create. That is the reason we say health is wealth. But we never say wealth is health. We say health is wealth. Yes, T is very, very important. That is time period. And why Buffett is so rich? It is because he started at 12 and even at the age of 90 plus, he is still there. His T is 78 years. So I started investing in market and all that stuff when I was at the age of 23. Now, people ask me why you are still not in the list of top 10 richest people, because still I'm 39 now. And I'm telling you, the power of compounding to work takes time and you should know the science behind it. And let me tell you, if you remain healthy and if you can increase the time period, then yes, your power of compounding works very beautifully. So earning, if you cannot increase your R, that is return on investment, you have to increase your time. Or if you cannot increase your time, then you have to see whether can I increase my ROI by more learning, by more ensuring you are picking the right stock, you spend more time on market analysis, or you have to increase your initial investment. But if you can do all the three, the compounding effect works more powerfully, where I can increase my initial investment, where I can increase my ROI, and where I can increase even my time period. Okay, so with this, let me just move to the next important topic for equity investing. So we have just now learned the power of compounding, and this is how I told you to make that 100 crore. What we require is just 10 lakhs initial investment, a 26% ROI with 30 years of time frame gives you 100 crore. Even if you don't do that, let us say, even if you can do it with 10% even ROI, I'm sure if not 100 crore, even 50 crore, or if not 50 crore, even 30 crore, 10 crore, that is enough. Put that money in a bank FD, even at 5% interest on that money, you can surely achieve your financial freedom. So let us understand the current economic scenario and even stock market behavior. Now, many of us talk about valuation. Many people say, no, markets are very expensive. But let me tell you, quality always comes at a cost. Quality always comes at a price. And good companies with good business model, with good moats, and if you are buying a great management and a great company run by a great management, you can't expect that at cheap price. Unless there's a crisis, that is when you have to be greedy enough to buy when the street is very, very fearful. Now, if you see valuations of many companies, I can give you a big list. Look at IRCTC, look at IEX, look at Deepak Nitrate, look at Apollo Hospital, look at Titan. All these companies, and I can name much more. Do we have cheap valuation or valuation comfort if I have to buy these stocks today? Definitely no, because quality comes at a price. Where I have a higher visibility of earnings, I have to pay higher premium for it. So are the P's cheaper here? Definitely no. But let me tell you, You have many stocks where you have valuation comfort, but there may not be growth there. I'll give you an example. Look at Yes Bank. You have so much of valuation comfort in Yes Bank. But will I buy Yes Bank because it is available at what, 10, 12 rupee, 13 rupee? Definitely no. You have valuation comfort, but I don't have anything to talk about the business of Yes Bank. I don't have anything to talk about even the management. Only retail people are stuck in Yes Bank. And I was the first person to tell in the whole country, say no to Yes Bank. I repeat again, say no to Yes Bank. The amount of wealth what it has destroyed from levels of whatever price, 450, 500, people kept on averaging thinking that they will get Yes Bank to move up one or the other day. And today, people know where they are. But let me tell you like this, I can name many more companies. So if you have a problem with the business model, if you have a problem with the management running that business, even if there is valuation comfort, there is no meaning buying that particular stock into your portfolio. Time is too short for me to talk about stock selection process, fundamentals, technicals, all that stuff. But still, I'm giving you an overall idea on how one can still pick stocks and not to do mistakes like this stock is very high on valuation. Yes, IRCTC has 100% monopoly when it comes to that catering business of railways. So can you expect that stock to come at cheap valuation? Definitely no. Only during the IPO issue, yes, it was cheap. And for a long time, even during when market crash happened because of COVID, you were getting IRCTC at 1,500, 1,600. Even if someone has bought at those price, which is 5 times the IPO price, even at today's price, people have made at least 5 times the money. So I'm only trying to tell you, it is better to buy good companies at high valuation than buying wrong companies at cheap price. Let me tell you again, it is better to buy quality companies at high valuation than even buying bad companies at a cheap valuation. But if you can buy good companies at a cheap valuation, that is a great combination. However, a bad company but at high valuation is never a good combination at all. So I always say, as a beginner, start not with mid and small cap. Buy even companies which are rich in valuation, but I want you to buy great businesses run by good management. And that is where I say, once you get that comfort and understanding of market pulse, then slowly move down the radar where you can even think of larger mid caps, small caps and all. But all this, whenever especially you want to put your money on mid caps and small cap, understanding even the company in detail, it is just not doing some ratios. Even let us say you want to meet management, understand what is their vision, mission, and their plans for the company. If you are able to get these things discounted earlier, and if you are able to understand their business and how it is run, that is when you can even go for a mid and small cap and then put your money there. So this is what I want to tell you about current economic scenario and stock market behavior. And there's a very crucial point I want to put in here. Please understand, today's market price is a reflection of not today's economics. Now, before even I go here, I know some of you might have some questions to me. I will open it up for the Q&A at the last. Please make note of your questions and ask me at the end. Once I complete the presentation, I will take the questions from you. But let me tell you very clearly that do not do this mistake of asking the question, today economics is so and so, why today market is falling? People ask, COVID cases were rising and it was bad, economics was bad, but market was also going up. Why? Today's market is not based on today's economics. Today's market is discounting the expectation of market participants might be for next 1 or 2 quarters ahead. So it is the future economics which is getting discounted in today's price. So I'll give you a very simple example. Bharti Airtel for a long time was a loss-making company, and quarter on quarter they were making losses. But still the share price was trading at 500 rupees. Why? Because people are investing, paying 500 rupees in Bharti Airtel, even though it is a loss-making company. And that is because they expect in future the stock or the company to deliver profits. And that is what is getting discounted in today's price. I'll give you the most simple example. Look at yesterday Titan results, fabulous result. But the stock was coming down today because the fabulous result is already there in the price. See the move in Titan for last 3 months, 6 months, 1 year. And if everything is already there in the price, or if it is already discounted, yes, there is profit booking which happened today. And let me tell you a very important statement. For short-term market, for very short-term market might move based on psychology, might move based on the greed and fear factors. But for long-term, market is always a slave of earnings. So there's a famous quote, stock prices are always slaves of earnings. So if you're able to buy good companies whose earning growth is always there, that is when you have to see whether you have the valuation comfort and then put in your money, because I even want margin of safety when I invest. What is margin of safety? Trying to buy as low as possible compared to its fair market price so that you're able to make your profits. So let me tell you, when it comes to market behavior, today's market price is just a reflection of future expectation of market participants and not based on today's economics. Don't do this mistake. Next, stock prices, their behavior depends on macroeconomic factor, industry or sector related factor, and even company specific factor. So you have to understand all these three plays an important role, and it is just not only macroeconomic factor. And also understand, just now I gave you an example of Bharti Airtel, even a loss-making company will be trading positive on the share price. That is for a simple reason, market as of today is discounting the future expectation and not just what today's actual is. Now, what are the sectors which can outperform in future and what are the sectors which might underperform? All these are practical insights and inputs I'm providing you with the contextual understanding and also the fundamental learning of equity investing, starting from the very basic financial freedom, passive income, power of compounding, from there till this level of understanding the equity market investing I'm providing you. And this is my expectation, whether there is COVID or no COVID to continue, I feel IT will still outperform because of lot of benefits what the sector gets. Whether it is through work from home, they're able to save a lot of fixed overhead cost and they're able to tap good employees at a cheaper price, even going to tier 2, tier 3 city, all that can be a big sector which can still outperform from current levels. So IT is a sector which can do good, and automobile, again, specifically into electric car segment, all that can also do good. And pharma can again be a great sector. So these are all sectors which I feel can outperform. Again, we have many more. So whenever you see real estate, for example, I feel is a great sector which can outperform. Specifically even related to real estate growth, related to, let us say, your paint industry, related to even your, let us say, your plywood or whatever we use for house, all that can also be something which can be watched for. But in these sectors, again, you have to go inside and pick good companies which are available at good valuation. When I say good valuation, at better prices for you to be there into it. And you have to understand the story behind, the business model behind, and how the company is performing over a period of time. It is just not looking at some ratios and buying companies. You have to do much deeper understanding of companies. Okay, so I always say having the right mindset is very, very important to create wealth in equity market. So I always say, unless you have the mindset of a wealthy person, you will never become wealthy. So it is not like after I become wealthy, I will have the mindset of a wealthy person. It is to become wealthy, first you should have the mindset of a wealthy person. So you have to think like a wealthy person and you have to learn these techniques and secrets, whatever I'm sharing for you in order to do the right equity investing to unleash or to make that wealth what you want. So how to get right mindset? People ask me this question. So I've just put 5 important points. A healthy mind is very important, like how you exercise regularly for your physical body. Even exercising regularly for your mind is important. Whether you do it through meditation or a few other means, whatever you have, you can do that. Power of association plays a very important role. Jim Rohn says this beautifully. He says, tell me who are the 5 people with whom you are associated with or with whom you spend the highest time. I will tell you who you are. So ensure you spend your time with right people, and that is where power of association works. Power of thought. It is very important to have that right thought, because thoughts will lead to you to have the right beliefs. Beliefs will lead to action, and action will lead to result. So if your thought itself goes wrong, the result or the final output will surely go wrong. Never give up attitude. This is something which made my life to change. You have to understand where you have gone wrong and you have to correct it, learn it. Awareness is very important, and especially that will help you to know where you went wrong. And in fact, I always say the costliest part of a mistake is not learning from that mistake. So mistakes are done, failures are there even to all successful people, but these guys learn from their mistake and they don't repeat them. So that is where never give up attitude, and also taking responsibility plays a key role. People blame everyone when they make losses, but when they make money, they say it is all because of me. So Benjamin Graham, guru of Warren Buffett, says this beautifully. He says, if you are making money or if you are losing money in market, it is you who is responsible for it. Don't blame your broker. Don't blame your financial analyst. Don't blame your luck. Don't blame your parents. Don't blame your environment. It is you who have to take the responsibility, because you have made the choice, but always try to make the right one. And whatever information is available with you, with that I have to make it. So having the right mindset is very, very important. And especially, as I told you earlier, having the right temperament to understand the situation and to act upon it as early as possible is the key for equity investing. Now, I'm just giving this last story. I just told I'll just take about an hour's time to complete the presentation. So I have 2 more stories to go. This is a story of intelligent person versus a wealthy investor. Now, before I just proceed, just want to ask if the whole program and the talk, is it in the right speed, and if you are able to catch me? If yes, can someone tell me yes? I'm able to see Deepa right now. Is the audio, video, presentation, everything going on smooth, madam? If you can confirm me.
Yes, sir. I'm really enjoying it.
Okay, thank you. So we'll just try to see even others and their opinion later.
Sure.
I just want another 5-10 minutes time to complete this entire presentation, and
Sure.
then can we go for Q&A, and can you moderate and take the questions?
Yes,
And
we will do that, sir. We will do that.
Thank you so much, madam. So
Thank
let me just get back to the presentation, another 5-10 minutes, and then we'll go for Q&A. And I'll also be sharing this PPT. You can definitely just share that with your participants. Okay, so this is the story of an intelligent person versus a wealthy investor, and the answer is already there on your screen. If you just Google and try to find out who is the most intelligent person ever in this world. So if you try to find who is the most intelligent person ever found till date in this world, the answer is Sir Isaac Newton. So this fellow is the most intelligent person in this whole world found ever. And Sir Isaac Newton, the most intelligent person ever born in the history of mankind. This person also invests in stock market. And let us see what happened to his stock market investing. And I'm talking about the most intelligent person in the world ever. And see what happened to him. So back in 1720, Sir Isaac Newton, I'm talking about 17th century. Back in 1720, Isaac Newton, he had shares of a company called South Sea Company, and this was a trader favorite stock in England during those period. So Sir Isaac Newton started buying shares of South Sea Company, and see what happened. He sensed that market was getting out of hand, and he had bought some shares of South Sea Company. He sold all the shares, he dumped them, and he made a return of 100%. And in 1720, he made a profit of 7,000 pounds. That was a very big money that time. And Sir Isaac Newton was so happy having made 100% return just for a few months by buying and selling the shares of South Sea Company. And he pocketed a profit of 7,000 pounds. But let me tell you the later part of the story. Just few months from there, he was swept in the wild enthusiasm of market. He was again jumping up and down, and he was buying and selling, and he again bought at a higher price South Sea Company, and finally, forget what he had made, 7,000 pounds, he totally lost 20,000 pounds in all. He lost so much for the rest of his life. He forbade even anyone to even speak the word South Sea in his presence. If you just even utter the word South Sea, he would get so angry and he would not even allow you to speak that company name in his presence. And this happened to the world's most intelligent person. And after this story, it was this what Sir Isaac Newton told. He said, I could even calculate the motions of heavenly body. That means he can find out the difference between or the distance between Jupiter to Mercury, or from Earth to Moon, or he can even calculate the motions of heavenly body, planets. But he could not calculate the madness of people in stock market. And he was not an exception. And let me tell you, Sir Isaac Newton could calculate the motions of heavenly body, but he could not calculate the madness of people in stock market, and he was not an exception for it. And Benjamin Graham, the guru of Warren Buffett, he was asked to do a research on why Isaac Newton lost money. And Benjamin Graham gave a superb answer on why Isaac Newton failed in stock market. He said, by letting the crowd override his own judgment, the world's most intelligent person acted like a fool. So was he the most intelligent person? Definitely yes. But he had only the intelligence, but not control over his emotions. So IQ is one side, but EQ is also very important when it comes to stock market. So intelligent quotient is just not enough. You should even have the emotional quotient. So the biggest place where Isaac Newton failed was in controlling his emotions. And that is what I have put in here. Sir Isaac Newton was an intelligent person, but he was far away from an intelligent investor or a trader. By letting his emotional imbalance overrule his intelligence, he failed miserably in stock market. So I have seen many people who are brilliant, but they lose money in market only because they are unable to control their emotional outcomes. And if you are able to have both IQ and EQ, then only yes, market is a place to create wealth. And let me tell you this another very important story which gives you the crux of equity investing. And this is a story of Rick Gureen. And Rick Gureen was very, very close friend of Warren Buffett. And I tried even searching the photo of Rick Gureen. It is not available. But let me tell you the story of Rick Gureen as narrated by Warren Buffett. And Buffett tells this beautifully. He says, Charlie and I always knew that we would become incredibly wealthy. Charlie Munger is one of the friends of Warren Buffett. And let me tell you the story. Three people story this is. It is, you had three people here. One is Warren Buffett, second is Charlie Munger, and third is Rick Gureen. And these three people were so close friends, and they were all equity investors. But if you see, only Warren Buffett and Charlie Munger made tremendous money, but not Rick Gureen. But Rick Gureen was as smart as Charlie Munger. He was as smart or even better than Warren Buffett. But what happened to Rick Gureen and where did he go wrong? So I will just definitely tell you that where he went wrong, and let me just get back, and I'm just putting the slide back and then telling you the reality. So let me just give you that numbers and the reality. So if you see where Rick Gureen went wrong, let me just tell you that. So I'm just getting back to this slide. Yeah. You're able to see my slide? Yeah.
We can see.
Yeah. So getting back to the story where Rick Gureen went wrong and how come only Buffett and Charlie Munger succeeded, even though Rick Gureen was more brilliant or he was more shrewd, more intelligent than even Warren Buffett and Charlie Munger. So Warren Buffett said, Charlie and I always knew that we would become incredibly wealthy. They were very sure they will become wealthy. But what they were not knowing is when. We were not in a hurry to get wealthy. Both Charlie Munger and Warren Buffett, they were not in a hurry to become wealthy. We knew it will happen or it would happen. But however, their close friend Rick Gureen was just as smart as Buffett or Munger, but he was in a hurry to make money. So Rick was not ready to wait out. And see what happened to Rick. In 1973-74 downturn, Rick Gureen was highly leveraged and he had a lot of margin loan. And in that year of 1973-74, stock market in US came down by 70% in those 2 years. And because of margin and because Rick wanted to become wealthy very fast, he was highly leveraged. He had no other option but to sell all his shares of Berkshire Hathaway. So Berkshire Hathaway is the company. What today Warren Buffett is the major investor and the owner, and Rick Gureen, who had shares of Berkshire Hathaway, he had no other option but to sell those shares to Warren Buffett. And let me tell you what happened in this story. So finally, when Rick Gureen was forced to sell his shares of Berkshire Hathaway to Warren Buffett, he sold it at a cheap price of $40 per share. So Warren Buffett says, I bought Rick's share of Berkshire Hathaway at $40 a piece, which is now over $4,33,159 per share. And this is without counting dividend. We have not considered dividend. Now, if you calculate the return, I'm just doing it right now on my mobile. So it is 4,33,159 minus 40, and this divided by 40. And if you do it into 100, the return is just 10,82,797.5%. I repeat, it is 10,82,797.5%. That is the money what Buffett made, and Rick Gureen sold his shares at throwaway price to Buffett because he was highly leveraged and he was in a hurry to make money. And let me tell you my side of Rick Gureen. I said Rick Gureen was more intelligent and shrewd than Buffett and Munger, but he was not wealthy. But he did not become more wealthy because he wanted to become rich quickly. This is the mistake what Rick Gureen did. And let me give you my last slide. The illiterates of 21st century are not the ones who cannot read and write, but those who cannot learn, unlearn, and relearn. So thanks for this wonderful opportunity given by the entire team of ICAI Ernakulam. And let me open the dais for Q&A, and let me just tell you this: not taking calculated risk is the biggest risk of life. So if you think you should not take risk, that is the biggest risk of life, but do take calculated risk and never a foolish risk. So with this, let me just stop my presentation share and open the stage for questions. So if I can just take help of the coordinator here, Deepa, if you can help me out, and if you can also open the chat box.
Yes, I have checked the chat box. Right now, nothing has come. So this is a
Okay,
request.
you can just ask the participants the way to put it across. If you can just put some ground rules and then help them out for asking questions to you.
Dear participants, this is one of the best opportunities. We've got a tremendous knowledgeable person amongst us. In case you have any queries, please do post it. Oh yes, we've got the first question, sir. See, Thomas Abraham is asking, is investment in listed shares a long-term option?
Definitely, yes, sir. So, in fact, the whole talk, what I did here was keeping in mind the listed shares only, but especially if you're putting money in an unlisted company, there I say management is everything. You are investing on a company which is still at a very nascent stage and we don't know whether it works or not. But let me tell you, whenever you buy companies, for example, these unlisted shares, you have to have a longer time frame, number one. Number two, you should know the management very close and understand their business very well. Number three, you're there betting on the jockey, not on the horse. I say management is the jockey, the horse is the business. So you have to be very, very careful. And let me tell you the reality. Even I have invested a lot in unlisted companies, but then out of 10 unlisted companies, if you invest, only 1 or 2 will perform. The other 8 will not. But the money what you make from those 1 or 2 is so substantial, it will take care of your losses in the other 8. But when it comes to listed company, it's a different ball game. The company would have already come to a certain level in the growth cycle of that particular company, and you are betting on not something which is altogether new. So you have to have a different mindset and a different style when it comes to investing in listed as well as unlisted stock. Thank you so much. Hope I've answered this question.
Sir, he actually meant SME listed shares.
Okay, so we even have this is something in between. So I can just tell you there are these small companies where there are no big regulations like the direct NSE listing part. That is the main board. So even you can put your money in SME. That is still in the listed space only. But then I can tell you, when you're putting money in these type of companies, you should know in and out. You should bet there more on the promoter, or I'm telling you, you should understand the business and the person running the business very well. Don't put too much of your money. Out of your total capital, if it is hardly a small percentage, it is worth taking that kind of a bet.
Thank you. Participants, if you have any more questions, please post on Q&A box.
Anything from your panel, if you want to ask, or any of your team members?
So we'll just give them a minute or so in case somebody wants to ask you something.
Okay, I got another question here from Sean Christopher in the chat box. Can you help me out with the question?
So I cannot see Sean's question. I think it has been given to you directly.
Oh, okay, so then in fact the other question what you asked me, I could not say it. Okay, I'll just read out the question for everyone here. Sean is asking me a question. Normally we see in Facebook 1 lakh invested in Havels in 1996 became so many crores now. Is it right way of looking at investment in stock market? Super question. Thank you so much, Sean, for Sean Christopher for asking this question. Yeah, people talk like this, right? If you would have invested 10,000 rupee in MRF, by now it would have become 500 crore. If you would have put 1,000 rupee in Motherson Sumi, it would have become now this much. if you would have put this much money in Infosys in 1995, today it would have become this much. But they never speak if you would have put money in Pentasoft, if you would have put money in Satyam, if you would have put money in Kingfisher Airline, how much it would have become today? It would have become zero. Let me tell you, it is easy to talk. If you would have put money in Infosys in 1996, it would have become so much today. But let me tell you, if you would have put is different from I have put. And second point, let me tell you, today I have to find the next Infosys which will do that kind of a return in next 15-20 years, because me putting money today in Infosys, today 1,000 rupees or 10,000 rupees will not give me that kind of a return, because the base is already bigger. Let me tell you, it is easy to make 10 rupee, 100 rupee, but it is tough to make 10 lakh rupee, 1 crore. But ROI is same on both. So my point here is, if you are a seasoned investor, see, if you are a very new person to stock market, these are ways how people will make you excited in stock market. Why all that? I will give you another example. If you would have put 1 lakh rupee in real estate in Malleshwaram in 1940 in Bangalore, today it would have become 10 crore. But let me tell you the time period involved there. And in 1940, the amount of investment, that 1 lakh, was very big. Today, because of time value of money, the 1 lakh of 1940 and 1 lakh of today does not have the same time value, because there is inflation. I want everyone to understand, you cannot fall in prey with these type of statements. But let me tell you, yes, the job here is to find the next Infosys, the next Wipro, the next HDFC Bank, the next MRF, the next Reliance, and that is where you have to put in your time, effort, and understanding. But for freshers in stock market, this looks very exciting, and this is how one can advertise well. Okay,
So,
question.
Yeah, one more question has come from my friend Sean Christopher.
Okay.
He's asking for your suggestion for investment in companies with huge valuations and running at a loss, like Zomato, Paytm, Policy Bazaar, etc.
Okay, let me tell you, first of all, you have to understand two important things. One is valuation comfort. Second one is growth. As I told you, growth always comes at a price. Quality comes at a price. But I don't see that amount of quality or comfort of price in Zomato. And also the other problem is, whenever I do these type of sessions, especially for people who are new to market, they will somehow or the other pull me for stock names. What are your recommendation? What to do with this stock? And let me tell you, there is no one called God in stock market. Everyone goes wrong. It is your temperament, the time what you stay in market, the portfolio what you have, the amount of money what you have put in which stock, all that matters a lot. Even I had Satyam in my portfolio, but that was less than 1% of my total portfolio. But my friend had 99% of his portfolio only in Kingfisher Airline and in Satyam. And you know what is the impact or difference today. So stock allocation in your total portfolio plays such an important role. And let me tell you, when it comes to Zomato, if I have to answer that, I don't have profitability at all. I don't buy companies which does not have profitability. Number one, do I see in near future that it might become profitable? No. And do I have comfort of valuation? No. Now people ask me, then why is it trading at 130, 140 or whatever is the price? Because we have a bigger pool to buy it. So I am not a person who will love buying these type of companies. But however, you look at company like D-Mart, look at company like Titan, look at company like Asian Paint, look at Pidilite Industry. Now these are all great companies which have profitability. But however, they don't give you valuation comfort. They are not available to you at good price. But still, let me tell you, if you buy a great company, even at higher valuation, over a period of time, it will look normal. You don't have to sell those shares. At least the money what you have invested will come back after some time. But if you buy bad companies, even at good price, that is even a cheap valuation, you may not even get back the price. So the question here is, if you are buying a good company at high valuation, then you have to spend more time remaining invested in that stock. Don't try to time the market, spend more time in the market. But however, me as a trader, I have a different hat. Me as an investor, I have a different hat. Trading is to earn money to invest in good stocks. You cannot create wealth through trading. You can only create some profits. But to invest in good companies, I don't have unlimited capital. I want some money. That's how I generate it through trading. So you have to understand each of these are different. It requires different trade. You can't be the same person as a trader and as an investor. But still, let me tell you, buying great companies at high valuation is far better than buying bad companies at cheap valuation, because never your price will come back. Someone bought Yes Bank at 300, 200, 400, 450. His money will never come back. Let's say someone bought Bajaj Finance at 4,000 and in the market correction that stock came to 1,800. So from 4,000 the stock came to 1,800 and today the stock is at 7,600. Let's say market corrects and Bajaj Finance from 7,600 can come to 6,000, 5,000. But later on over a period of time again the stock will go up. So what is very important is if you can buy a great company at cheap valuation, that is even you have valuation comfort and it's a great company, that's a fantastic combination. But at least I will tell you, buying a great company at higher valuation is still far better than buying a bad company at cheap valuation. So Zomato, I personally don't like nor I put my money, but few other companies which I told which are very high in valuation is still far better than buying a bad company at cheap valuation. Hope I've answered that question.
Yes, sir. I guess you have very clearly.
Okay.
Now, one more question from CA Sean. So you've mentioned that
give chance to even few others. This is the third question of Sean, I think.
yes,
There are other questions also.
he's a very active member of our branch. So if you want to take somebody else's question, that's fine.
Or we give chance to everyone, right?
Sure, sure.
Yeah.
Now, I'm not able to see anybody else's question. So
okay, I have a question here from James Kutti and Tony. And he is asking me this question. He says like, which are the most important ratios to be looked into before investing? A good question, and let me answer. There is nothing called important ratios. Each ratios will test one part of the company. Now let us say you are more interested to see the solvency position of the company, or you're more interested to see the, let us say, profitability of the company. You're more interested to see the valuation side of the company. Then the ratios what I see are different. But however, generally I will say something like a P ratio, something like a P to growth ratio. And I always see whether there is growth in earnings or not. And I compare the individual companies' ratios with that of the industry average and see how much are they outperforming or underperforming. Is the company highly leveraged? What is their debt component? Do they have the capacity to service their debt? So these are all few things what you do. But I'm a guy who bets more on the company's business model, on the monopoly. What if the company by chance enjoys and do they have any moat? And I bet more on the management, the jockey. And generally with my experience, what I have in market, I pick up more stocks from larger mid cap to small cap kind of stocks, which gives you a great return, but you have to do a lot of homework and put in time. Very simple. You either drive your Benz car, or if you don't know, at least you should have a good driver so that you can sit back and enjoy. So there is a lot of effort and result has a correlation always. It all depends what is the time you are ready to put in to get that kind of a result. So I've just answered this question. I've also mentioned some ratios which James Kutti Anthony has asked. Okay, I have another question here from Krishnan Menon, and he's asking me, is it worth investing in large cap for long term as a hedge against inflation? So if you want to do investing as a hedge against inflation, I would recommend you to look at gold as an investment alternative. And if you are looking for only inflation, gold can be a better one. when it comes to stock market investing, there is nothing like only large cap I have to do as an hedge against inflation. It all depends which company are you buying, because the large cap basket is also so big enough, and you have to select the right stocks from there. So that's the answer. But gold will be a better hedge against inflation if you are particularly looking for inflation to be taken care. So hope I've answered Krishnan Menon question. Then I have question from Srijit. He's saying we see a lot of moving average in stock market like EMA 7, EMA 21. What does this mean and what does it indicate? Okay, EMA is nothing but exponential moving average. So EMA 7 means it's a 7-day exponential moving average. EMA 21 means it's a 21-day exponential moving average. And this is part of technical analysis where people try to predict the short-term price movement using the art of technicals. And the rule is very simple. If the current price of the stock is above the EMA, for example, you are using a 21-day EMA, and if currently the market, the stock price is trading above the 21-day EMA, then we say it is bullish. If the price is trading below the EMA, then we say bearish. So this is very short and sweet answer for such a big question of technical analysis what you have asked. Hope I've answered your question. So I don't have anything more here. You have any questions, madam? More?
Yes, Sean's one question is pending, so if I can take it up now.
Yeah, please go ahead.
So
if you have no other questions, then we can take all Sean's question, no problem.
Sure. Sir, you have mentioned that rupees 10 lakhs investment for 30 years at 26% will make rupees 100 crores. Then in one's portfolio, how many companies, that is number of companies, should one stay invested in?
Very good. I can make this question more simple. Sean is asking, is it good to have a concentrated bet or should we have a diversified bet? So again, this is a debatable point. Warren Buffett says for his lifetime, he does not want to buy more than 20 companies. He even keeps a punch card and he says the moment he buys one company, he punches his card and he says, I cannot punch more than 20 times for my lifetime. Again, I can tell you whatever he says and whatever he is telling is all about long-term investing. But I'm sure at the early ages of his investing career, he would have also done a lot of trading. Because once you have substantial wealth created and all your short-term goals and wishes are taken care, then yes, one can do this. At my age, if you ask me, I cannot follow the rules of Buffett at least to the full extent. And I do respect him. I do follow him. I do make a lot of quotes of Buffett and I do implement them even in my investing world. But let me tell you, when it comes to concentrated bet, I say George Soros answers it so beautifully. He says, you have to load your truck when you get the right investment. Now, let us say, I'll give you the simplest example. I bought a stock called Shilpa Medicare, and it is a Raichur-based company in Karnataka, and I bought this stock at 50 rupees, and I sold it after 4 years at around 700 rupees. I bought at 50, sold at 700. And my friend, who also bought Shilpa Medicare, he bought the stock at 30 rupees and he sold it at 1000 rupees. He bought at 30 and he sold at 1000. And I bought at 50 and I sold at 700. I'm sure who is better? Is it me or my friend? Yes, I want some answer, Deepa.
Well, given the points, I would say your friend.
Definitely, yes. My friend is better because he bought at 30 and he sold at 1000, whereas I bought at 50 and I sold at 700. So my friend made more return. Now, two important points. One, what is the time frame he has been invested in that stock? And what is the time frame I have been invested in that stock matters. Number two, my friend had only one share of Shilpa Medicare. He bought at 30 rupees, sold at 1000 rupee, and he made a profit of 970 rupees. I only had 1 lakh shares of Shilpa Medicare. Size matters. So when it comes to great investing, you might have got the great stock. You might have researched the best stock, but if you have not put in enough money there, and most part of your portfolio are there allocated in wrong stocks, which are not performing, then your overall portfolio does not make money. So it is important to know even the asset allocation into the right companies. And this is where George Soros says, It is not important how many times you are right or wrong in stock market. He says what is important is when you are right, how much more money you made, and when you are wrong, how much less money you lost. That matters a lot. And let me tell you, only two people are right always in stock market. I repeat again, only two people are right always in stock market. One is God and second one is a liar. Except these two people, you can't be right every time in market. That is where risk management plays a very important role. And if someone can understand this, you know what, or overall, you know how to make money in market. So if you want to make money from all the investments what you make, then you are challenging the market. You should either be God or you should be a liar. Buffett has also gone wrong in many of his investment. I have also gone wrong in many of my investments. But what is more important is when you are right, how much more money you made, and when you are wrong, how much less money you lost. That matters. Never fight against market or against your wife. Always you lose. Next question.
So what I can see is again from Sean. So
Okay, go ahead, madam.
investment magazine.
I have one question here from James Kutty Anthony. Can I take that question?
Sure, sir. Sure.
Yeah, he's asking, do you have any suggestions for future of Infosys? I will say it is a great company, no doubt, but can't expect the same returns what it has given from its inception to today. But start with investing in good companies, large companies like this, slowly go for mid and small cap, depending upon your expertise level what you have. Okay, one more question from James Kutty Anthony, and he's asking which is better, profit booking at periodical intervals or keep invested for long term for 10 years or more? Answer is very simple. It's like you're asking, should I play T20 or should I play test match? If you are Rahul Dravid, test match is better. And if you are Virendra Sehwag, then T20 is better. Depends on the individual's style, temperament and all. But as of now, let me tell you, gone are those days where you can buy any company and wait for 10 years and you make money, because the amount of technological changes and the amount of disruption which is happening in almost all industries is so fast, and you have to be on your toes. Gone are those days where you put your money and sleep for next 5 year, 10 year, 20 year and you create wealth. But let me tell you, trading only gives you profit. Long-term wealth is always through investing, but you can't just copy the last 30 years kind of a style. Earlier in cricket also, in a ODI match of 50 overs, a score of 250, 300 was great. Today even 400, 450 is getting chased. Even in T20 match, 120, 150, 160 was enough. But now even 180, 200, 220 is getting chased. So you have to adapt to the changing market environment. Change is the only change, and you have to change. Okay. So next question, I have one more. Let me take it. This is, I think James Kutty Anthony is putting all his questions to me, and for Deepa you have Sean. So
yes,
very, very intelligent. Okay, great. Go ahead. We can take some Sean's question.
Yes, sir. The last question from him is investment magazines that you follow or read regularly. You would like to know about it.
Google.com. So let me, I don't want to see, because today media has also been paid enough to print all the things which are required. And I don't know if I can put all these things so officially in a meet like this. So if some investment magazine and all the recommendations there would have made Warren Buffett and Rakesh Jhunjhunwala, then everyone would have bought the newspapers, the magazines and all that. Take that information, but use your head and then put your money there where you are comfortable. But again, if you want me to recommend some of them, you have many more, na? Dalal Street, and you have the Capital Line, you have the daily newspapers like your ET, Business Online, lot of things are there. And you have many portals today. See, what happens is these periodicals, journals, and the newspaper, right? They cannot give you the next second information. Today, internet is so powerful. So something happens right now, the paper can only take it up next day. And something has happened after the paper has got printed, I may not get that covered. And when you go to these periodicals or journals and all, if they are weekly or fortnightly published, the delay in data and the time becomes much more. So today I feel I don't go through any of these stuff, because everything is there on mobile, and everything is available through internet. Okay. Can we end? So we have about 12 minutes to close. If you want that for word of thanks and saying like, thank you, Rudramurthy, in your busy schedule, you have given us time and made this presentation a fabulous one.
I would like to actually propose a different vote of thanks, but then before that, CA Thomas Abraham has asked one more question.
Okay, go ahead.
A bit out of context, how bullish are you on Bitcoins in Indian context, given the fact that China has banned?
My one single line answer, I have not put even a single rupee of my money in any cryptocurrency or Bitcoin, and I'll also not put it in future. I like to trade and invest and not gamble. And if I want to gamble, better I'll go to a race course or for a lottery or for a Goa casino or for Las Vegas, and not in stock market or not in these type of places. Yeah.
All right. So since we are closing this deliberation, so I take this opportunity to thank you for your presentation and speech, which was short, sweet, meaningful, and just like stock market, very volatile. We had to be on our toes to understand you and grasp whatever you were trying to inculcate into us. And I assure you, I'm going to read Mind Markets and Money. So some royalty for you there too. Thank you so much for joining us this evening. It was a pleasure listening to you.
Thank you so much. And my special thanks to CA Ranjit R. Warrior, the chairman, and also to Deepa Varghese, the secretary, and also to all the office bearers of ICAI there at Ernakulam. And I remember when I was doing my articleship, I used to come to an audit there at Ernakulam. But once I completed my CA, I have never practiced nor I have worked in any company. And I only that is what I remember, might be about 15 years back, to place like Ernakulam, Tirsur, Perindalmana, and some of these places. And Kerala, I love Shabrimala and I love Ananta Padmanabha there. And lovely place. It is the God's own country. And that's the place, or that's the people to whom I'm talking to. Really enjoyed this session. And thanks so much for each one of you for giving me this opportunity to share my small knowledge with you people. Thank you so much.
So you're welcome back to God's own country any day you want. It will be our pleasure to hold a physical meeting where our members can take advantage of your knowledge. Thank you so much.
Sure. Thank you so much. And I'll be sharing the presentation to you, Deepa. Yes. You can just forward that to anyone.
So we will be posting all these presentations as well as the YouTube on YouTube as well as on our website. So members will be able to access it through that.
Great. And also I'm just sharing my email ID. So if someone wants to reach out for Rudra, I don't share my personal mobile number, but I do share my email ID. If that's of use to anyone, they can definitely do that. And this is ca.rudramurthy@vachanainvestments.com, or definitely they can contact the Ernakulam branch for Rudra. Okay.
Thank you, sir. Thank you so much. And thank you, dear participants. We'll see you tomorrow evening again, or the third day, and that will be once again at 4 p.m. So Ernakulam branch signing off. Thank you once again to everyone.